there are some countries that have negative betas. For example, India is a classic example of a country with a negative beta against the Morgan Stanley Capital International World Index. The implication of a negative beta is that the expected rate of return, or the cost of capital, for a project of average risk within that country is less than the US Treasury bill rate. The question is that reasonable? Now, this sort of question really causes us to think about the fundamental foundations of finance. The most crucial foundation has to do with what is risk. The risk for the investor is usually measured with respect to a well-diversified portfolio. In that diversified portfolio, the volatility is the risk. So when we're assessing an investment in an emerging market, it's not the volatility of that investment that counts. It's how that investment affects the volatility of our well-diversified portfolio. And given that some of these countries have very low correlations or negative correlations, this implies that adding these countries to our portfolio actually reduces volatility. So indeed, this is why the capital asset pricing model makes sense. If we reduce the volatility, then people are willing to pay for that. Lower volatility is something that's valuable. We bid the price up, the expected return is lower. Hence, it seems quite reasonable for adding a company or a country to our portfolio that the expected return is low if it reduces the volatility of our overall diversified portfolio. But we really have to think about this. Is it reasonable to go to your board of directors with a project with risky cash flows located in one of these emerging markets I mentioned with low or negative correlation and suggest that the discount rate should be the Treasury bill rate? Most of us, I think, would be hesitant to do that. And the question is why? It seems too low. But the diversification argument is a very attractive argument. We're missing something. And what I'm going to argue that we're missing is, again, fundamental to finance. We considered the risk, the volatility. But the volatility is a very symmetric measure. It treats positive surprises the same way it treats negative surprises. What it ignores is the possibility of what I call catastrophe risk or negative skewness. And this basically means a dramatic negative return. And investors don't like big negative returns. And if we just evaluate with volatility, we might miss this. So indeed, to get me to purchase an asset that's got this possibility of a catastrophic downside, then the expected return better be higher, not lower. I'm not going to pay as much for that asset if it's got catastrophe risk. I want to be compensated for taking on catastrophe risk. I want to be compensated for bearing substantial downside risk. Again, everything comes back to the portfolio argument. If I add this asset to my diversified portfolio, then it could increase the downside risk of my portfolio. And this is something that I consider unattractive. Hence, when I look at some of these countries, I know that there's an ex-ante probability of a catastrophe, of the downside. You cannot simply look at the beta or the volatility to make the assessment of what the expected rate of return is or the cost of capital. You need to go beyond that. Investors clearly have a preference for positive skewness and a dislike of negative skewness. Given the dislike for this negative skewness or the catastrophe risk, that needs to be incorporated into the cost of capital. The end result is that we're not going to discount these cash flows by a treasury bill rate. We're going to discount them by a rate that reflects not just the portfolio diversification in terms of volatility, but something that reflects the implications of investors' dislike of catastrophe risk.